Alrighty, let's see. Welcome back, everybody. We've got a good one today. We're going to be talking Palantir stock, and all the Palantir bulls must be shitting their pants right now. I'm sure that all the Palantir bulls on YouTube were really hoping for a really good quarter, and I guess there's some good, but then not really much good. But let's go over a few things here. So first of all, before I get into the earnings or the financials of the company that I want to look at with the earnings, I kind of just want to address two things I would need to see with Palantir before I even considered making an investment. So the first thing I needed to see with Palantir was a continuation of free cash flow margins getting better. That's the main one for number one. But also, I need to see that margins are starting to get better over time and not stay the same or get worse. And the EPS also needs to start improving over time. So yeah, I need to see, because they did start to have positive free cash flow for 2021. So I need to see that quarters that come after 2021, quarter after quarter, you need to prove to me that now free cash flow is getting more and more positive, because to me that proves strength of a company getting better and better, but it also makes it easier for me to run a DCF model on them so I can project future free cash flows. So again, number one is mainly I want to see that free cash flows are getting better and better, but not only that, we also want to see that just other margins for the company overall are getting better, along with EPS as well. And number two is a really, really big one and has been a silent killer for Palantir investors that none of them seem to ever want to talk about or acknowledge. And as an investor, you need to acknowledge this, is share dilution. So number two, I need to see that share dilution is beginning to slow greatly or just come to a halt altogether. Share dilution's been terrible with Palantir, mainly due to stock-based compensation, and a lot of it. So again, it's been a really, really bad thing. And there's so many reasons it's not good for you. Like the basic explanation is you have this pie. I've got a whole pie and I've got 10 slices, right? So there's 10 slices. I'm 1 out of 10. So I get 10% of everything. And now you add 2 more slices to the pie. You just diluted it by a certain amount, and now I'm getting about 8.3% of everything and not 10% like I was before. So that's the problem when you have share dilution. So it doesn't matter when you're having this insane amount of revenue growth if you are really, you're having really good revenue growth and things are looking better and better, but it doesn't matter because you're offsetting all of it by diluting the hell out of it with stock-based compensation. You're diluting the shares. And when you dilute the shares, you actually fuck over the EPS too, which we'll get into that because that's part of why they missed. And another way to put it really, because it kind of combats the revenue growth, even if a company grows 30, 40%, if there was an insane amount of stock dilution due to stock-based compensation or because a company needed to stay alive through it, whatever the reasoning is, it's all the same. You diluted the shares of the company. Now you as a shareholder are getting less revenue per share because of that. So that's starting to offset whatever revenue growth there actually was. Okay, so let's go ahead and go to the screen here. I've got their Q1 up that they posted. Year over year, comparing the quarters, they grew 31%. Obviously 31%, it's good. It's not as good as their last year over year that they had, which was something like in the 40%-ish area or something like that. Okay, so you've got commercial revenue growth of 54% year over year, U.S. commercial revenue growth of 136% year over year. I mean, yeah, that's good growth. Congratulations. I mean, they've aimed to really grow in the commercial market, and they're posting numbers showing that they're clearly doing it. A concern of people before was that government revenue growth is slowing. And, I mean, you can see right here, 16% year-over-year growth, not really all that impressive in terms of growth in that sector for them. So here's one that I was afraid of. Here's your free cash flow, which was about $30 million for the quarter, which is only a 7% margin. Now, if anyone saw my Palantir video I did where I did a hypothetical DCF model on Palantir, I did it a while ago, like months ago. I based that entire model off of a relatively high free cash flow margin because it was just based on like the first quarter where they actually had some positive free cash flow, and it was a fairly good margin for that quarter. Not only that, I will have to explain here that when I ran that model, I was not conservative in the model at all. I basically used extremely aggressive, I did an extremely aggressive model. Palantir's management says you're going to get at least 30% growth, if not more, year over year for the next 5 years. I grew it out 10 years at 30%. I basically kind of took what management had already said and put it on steroids. That, and I used an inflated free cash flow margin based on one quarter. It was a very hypothetical thing, and including share dilution that I know the company is going to end up having. We came to a stock value of about 12, but that was based on an extraordinarily aggressive model that was based on management being very aggressive in what they think it'll grow at, plus an extremely aggressive free cash flow margin that we see doesn't even hold any water and it's not accurate. And we can see that here. This free cash flow of $30 million, first of all, the overall free cash flow for 2021 was like over $300 million. And now Q1 is $30 million. At only a 7% free cash flow margin, just really isn't that good. So when I was talking about things that it would take for me to invest in Palantir, one of the things was saying I need to see free cash flow proving that it can get better and better, over years and over quarters as well. And this isn't a quarter that shows that at all. We also have earnings per share of 2 cents. Which they missed because people were expecting 4 cents, and they missed the previous quarter too, where people thought it was going to be 4 cents, and it was 2 cents in the previous quarter as well. And look, this, people keep expecting a better earnings per share, but I don't see it happening, and I suspect that this earnings per share was sabotaged once again due to stock-based compensation, due to share dilution once again. All the Palantir bulls out there, I get it. You talk about, and not to rag on anyone, but you talk about a lot of story type stuff. You talk about how the story sounds good, but rarely do I see them ever really address the numbers all that much. And look, here's the thing. Even if you're going to build a model, I've seen some people build a model based on EPS growth through the years. You need to prove that the EPS is finally stabilizing itself out, stabilizing, before you can project EPS increasing through the years and getting a value for a company based on growing EPS. Now they've missed EPS estimates 2 quarters in a row and stayed stagnant right where it was at 2 cents earnings per share. Share dilution's a killer. You're not seeing free cash flow get any better. It got worse. And I think in these numbers here, as we go on, you'll see it compares to the previous quarter, and it's like much, much worse. But again, to the bulls, the bulls always like to talk about the story, and Palantir is going to do this, they're going to do that. But I mean, we need to pay attention to the numbers too and realize when you may not see margins get better. You may not see EPS getting better. You may not see free cash flow getting any better. And you have to acknowledge it's a problem. And anyone watching this video, I'm not meaning to upset anyone if you're a Palantir investor. I'm talking real talk and trying to provide information and facts and take it from there as you will. A lot of Palantir bulls talk a big game and they talk story. As I provide perhaps what some would view as a little more of a bear case, I'm providing numbers that aren't showing that this is getting better anytime soon. I'm not an investor until I see numbers make sense. That's personally me. And now you're seeing the stock price start to reflect that as in pre-market trading, it's dropped to like $8 a share. So let's go ahead and continue down with some of the financials here. You can see the revenue for the first quarter was, $446 million. Again, they're showing the year-over-year growth, which was 31%. We are guiding for a base case of $470 million revenue for quarter two, which, by the way, I guess besides them missing EPS estimates of, 4 cents when it was only 2 cents, it also is dropping because they're missing guidance. I wasn't aware of what the exact guidance was for, Q2 revenue, but they're guiding for $470 million as a base, and clearly, I guess people were expecting better because it's also dropped because of the forecast, apparently. Here they reiterate that through the year 2025, they're expecting 30% or greater for revenue growth, which, companies, even that seem like they're growing well, always have a bad quarter or even a bad year. If even one of these years misses where anywhere for the year through the year 2025 they don't hit 30%, there would be a major drop in stock price because this is something they've set in stone. We're expecting 30% or greater through 2025. And to make that big statement, and if they ever miss it even once, you'd see a bit of a drop off too. Okay, so if you look here, we can actually look at, you've got revenue again here comparing the quarters, and you have a cost of revenue. This isn't really a surprise here that cost of revenue would go up. It was $74 million here. It's $94 million here. Again, this isn't really a surprise that cost of revenue would go up because a lot of the time with growing businesses, as your revenue increases, cost of revenue will increase as well. But the question is, did the margin improve, stay the same, or get worse? So here's your gross profit. So now we want to calculate gross profit margins, which we can do by just dividing the gross profit by the revenue. So I got my phone here. Let's go ahead, 351 million. We'll just call it 351 divided by 446. And that's about 78% gross profit margin. And then we'll go 267 divided by 341. And again, it's about 78%. So basically, this gross profit, the revenue got better, but the cost of revenue went up. So your gross profit margin essentially stayed the same, which there's nothing wrong with a gross profit margin staying the same, especially when, it's a good margin. So it's as long as it's not going down, that's a good thing to see. See, I'm not just trying to make a complete bear case for Palantir. I'm just pointing out numbers and facts. The gross profit margin basically stayed the same. In fact, it was up like a smidge, but basically they were both 78%. Okay, so here in this quarter, you're going to see they're talking about stock-based compensation again. Now, it doesn't look like it was quite as much as the last quarter, but nonetheless, you're talking right here, total stock-based compensation again. So we know that it hasn't really slowed that much, and it certainly hasn't stopped. So that sort of affects my other view when I say Not only do I need to see margins getting better, EPS getting better, I need to see free cash flow consistently getting better. None of that really happened. But for me to invest in Palantir, I also need to see that the stock-based compensation really slows way down. And I mean, that's just not happening yet. This is part of what killed your earnings per share. That you wanted 4 cents, that people were expecting. As long as you continue to have a lot of stock-based compensation and share that causes share dilution, you're going to potentially keep missing EPS. It's just is what it is. And I know that they argue that, I guess the argument is share-based compensation needs to keep happening so that we can keep big talent on. It's funny. Stock-based compensation is only worth so much to workers when they think that the stock is going to do well. They keep seeing it do bad. I wonder how much people are really going to be interested in stock-based compensation when the stock keeps doing so poorly. I mean, yeah, total assets didn't really change that much. Total liabilities are practically the same, so nothing really changed much there. The net loss got a little less worse. That's good, I guess. Again, you can see the mention of the stock-based compensation that took place. Okay, purchase of property and equipment. This is going to affect your capital expenditure, which obviously could have affected that free cash flow. Obviously, when you're looking at the overall loss from operations compared to the previous quarter, that got a lot better. So, I mean, obviously, that's a good thing to see. That's something that you want to see. But unfortunately, overall, when you look, the adjusted operating margin got worse. So, these are the sort of things you don't want to see, is like any sort of margins getting worse. I mean, it can happen to a company comparing quarters, or even quarter over quarter or quarter to quarter, where maybe a margin goes down a little bit. But I mean, year over year, this thing went down it went down 8%. And just try to keep in mind before we move on, when you're talking operating margin, it essentially is a measure of how much profit a company makes for every dollar of sales. So, when you're looking at this, the fact that the margin went down, that's, obviously that's not good. You don't want to see that. We get into one of my favorites, is the free cash flow margin, baby. Woo-wee! Yeah, so obviously quarter over quarter, this is another margin that got way worse. Free cash flow margin's one of my favorites to look at. So this got substantially worse. Last year in the same quarter was actually 44% free cash flow margin, which is really good for that quarter. And now it's at 7%. And again, this is something where we just have to look at, it's basically we have to look at more quarters in the future and see if this progresses in the wrong way or a better way again. But for it to be a 7% free cash flow margin for this quarter, not what you want to see, not going in the right direction. Again, part of what affected that was, they did make property and equipment purchases. But you know what? I never liked to quite make the argument of like, wow, it was the one-time, big-time cost, because as the company grows, I'm sure they're going to have to keep purchasing equipment and properties. So I think it's different when you're talking about a really big company that makes a one-time purchase on like this huge factory, like what Intel's doing, or Tesla with their gigafactories. It's like, all the gigafactories Tesla is building, once those like kind of capital expenditures are added in, you're not going to have any more gigafactories built for a while. Those gigafactories are going to produce a lot for a long time. But it's hard to say how much more, capital expenditures for, certain quarters will be up because of property and equipment. And again, they talk here we go, stock-based compensation is what we're talking about. We know it was there. And I mean, overall, at the end of it, after adjusting for everything, you get 2 cents there, and the previous quarter was 4 cents. So, it's not going in the correct direction. Okay, everyone. We're pretty much gonna wrap the video up. Obviously, you know my thoughts on it. I'm not even interested in Palantir until you show that margins on all fronts continue to get better and earnings per share can start to increase. And I'm also not a buyer or even considering it until the crazy share dilution stops, because it's the biggest silent killer that no one wants to acknowledge. But okay, everyone, that's all I've got for you. Let me know your thoughts down below in the comments. And with that, that's all I've got. So y'all have a good one. I'll see you in the next one.